Today we're discussing Microsoft stock. Whether you're a beginner investor or a seasoned trader, here you'll get the facts, the figures, and the context. Can this stock outperform the market? We dove into Microsoft's numbers, and in this video, we'll share what we found. Welcome to Happy Investors, your go-to source for in-depth analyses of stocks and ETFs, for simple investing and financial freedom. We give you expert insights into stocks and ETFs that we analyze using exclusive databases and stock programs. Every week, we analyze dozens of stocks. We share the most promising ones with you. Want even more inspiration beyond our analyses? Check out our website for free downloads, like a calculator tool, free ebooks, and a free strategy session. Thanks to the program's Maxim, Morningstar, and FastGraphs, we look at a stock's long-term potential. With the help of market screeners and Seeking Alpha, we review quantitative and relative data for the stock over a period of 6 to 12 months. And with the paid programs Zacks Rank and TradeView, we gain insight into the short-term situation. Is it a buy or not? Do you also want access to these data sources? In our video description, you'll find special discount links from Happy Investors with our partners. Please note, this video is purely informational and not investment advice. Always do your own research before making investment decisions. Investing involves risks. Microsoft is an American technology company known for Windows, Office, Xbox, and the Azure cloud platform. It develops software, hardware, and cloud services for both businesses and consumers worldwide. The current price is $448.18. Analysts at Morningstar estimate an intrinsic value of $505 and give it a wide rating for its competitive advantage. The stronger the advantage, the better. If the current price is below the intrinsic value, that's favorable. Always calculate your own intrinsic value. Wall Street analysts estimate an average price target of $501.88. This indicates that analysts do have confidence in further price growth in the medium term. The historical results of this stock show an average annual return of 14.17%. If this percentage is higher than the index, that's favorable, but it does not guarantee future results. What are your expectations for the future? Note, the tool we're using here is most reliable for stocks with a longer trading history. For young or extremely fast-growing companies, the data may be less representative. In this chart, you can see the historical valuation of the stock. Ideally, the price, the black line, should be below the blue line, which represents the average valuation. It's even more favorable when the price is below the orange line. This line is often equal to a P/E ratio of 15, but it can be higher depending on profit growth expectations. The further the price is below this orange line, the greater the potential margin of safety. What exactly does that mean? Let's take a closer look at that together. In the following images, we'll look at the potential returns through 2027. The average analyst here looks at the past 5 fiscal years. For inspiration, we use looking back up to 10 years as our starting point. This has its pros and cons. Now, we'll look at 3 scenarios. Note, the actual return depends on the earnings forecasts, which are an average estimate from a certain number of analysts. The higher the number of analysts, the more accurate the estimate may be. Scenario 1. In 3 years, the price is equal to the 10-year average price level, with a P/E of 26.88%. If you buy this stock now, the average annual return could be 2.98%. Scenario 2. The better people think the company is doing, the higher the price for the stock can be. Suppose we assume a P/E of 32.20%, then the potential annual return is 12.06%. Scenario 3. However, it's better to be cautious in your calculations. Suppose we assume P equals 16.10%, then the potential annual return minus 18.6 is 1%. Do you have questions about these numbers or how to interpret them? Ask them in the comments. We're now switching to another data tool, Market Screener. The investor rating is 5 out of 5 stars. Ideally, you want the PE rating to go down due to rising earnings per share. Earnings per share is referred to as EPS, which stands for earnings per share. In general, the lower the PE ratio, the better. However, this ratio doesn't tell the whole story. That's why you should always look at the development of free cash flow as well, where you want to see a growing trend. According to analysts, the price/earnings ratio is expected to drop to 25.7 times in 2027. The P/C ratio for 2027 is estimated at 1.5 times. The further this falls below 1, the greater the margin of safety can be. Microsoft is showing profit growth expectations toward 2027. We can see this in the rising green and yellow lines. The next 3 images show a lot of information. Pause the video if you want to interpret all the information. Here, we'd like to highlight the cash from operations. We can see that the trend is upward. That's a positive sign. Here, we're looking at the profitability of Microsoft's business model. A consistently high or rising trend is favorable. Where we previously talked about a competitive advantage analyzed by Morningstar, we see that reflected in these numbers as consistently high profits. Strong, high-quality companies generally achieve high and consistent profitability above 15%. The return on equity is higher than 15%, and for the net income margin, we also see that it is above 15%. In this image, we're looking at financial ratios from the balance sheet to assess the company's financial health. In terms of the short term, the company does appear to be financially healthy. We can see this from a quick and current ratio that are both above 1. In the medium term, we see that total debt relative to cash flow, or EBITDA, is currently 0.74. This is below the ratio of 3, which is favorable. For the next images, we'll be using Seeking Alpha, a data tool that utilizes factor analysis. The factor analysis, expressed as the quant rating, ranges from strong sell to strong buy. Strong sell means a statistical probability that the stock may perform worse than average over the next 6 to 12 months. And happy investors, we ideally look for stocks rated from hold to strong buy. It doesn't guarantee success, but it can increase the likelihood of success. Keep in mind that this is a weighted average of various factors compared to the relative valuation of the sector average. For example, this means that a high-quality stock may have a high valuation compared to the sector average, but it could still be undervalued relative to its own intrinsic value. Take, for instance, the assessment from Morningstar. The quant rating from Seeking Alpha gives it a hold. Let's take a closer look at each factor. We'll start with the valuation factor, which ranges from A+ to F. In this case, the valuation compared to the sector average appears unfavorable. For the long term, the most important metric is the PG non-GAAP FWT. Ideally, this should be below 1 or below 1.5 for strong companies. Next, we look at the growth factor. The growth figures compared to the sector average are neutral. We pay particular attention to the EPS growth for the next 3 to 5 years, where a percentage above 15% is favorable. The estimates for this stock are an EPS growth of 12.17%. In this tool, we see that the profitability factor is relatively strong compared to the sector average. For example, we see that the net profit margin is 35.59%, which is higher than the sector average. Here, we look at the momentum of the stock. Stocks with strong momentum tend to maintain it. But remember, when a stock has a very high valuation or, for example, the growth expectations from the growth factor drop quickly, then a stock with only strong momentum can fall sharply. At Happy Investors, we mainly look for an attractive combination of all the factors, where essentially we either pay a fair price for a great company or a lower price for a good company. That's why you should always look at the intrinsic value in the long term. Microsoft scores strongly in terms of momentum grades. In this image, we see the dividend score of the stock, which is a combination of various components, from dividend security to dividend yield. As a dividend investor, ideally you want an attractive current dividend and reliable long-term growth. This stock pays out 0.73% in dividends. The dividend growth over the past 5 years was 10.24%. Now we're going to look at the very short term. For the next 3 to 6 months, the Zacks rank rating is a hold. Within a 6 to 12 month horizon, Zacks rank has a price expectation of. In the short term, you can use technical analysis to determine entry and exit points. We see a support level at the price points of $359.84 and $202.47. For the traders among us, we see a possible resistance level at $467.56 and at $410.37. Whether or not to enter is entirely at your own risk. At Happy Investors, we stand for buying strong companies below their intrinsic value for the long term. In this video, we highlighted the Microsoft stock. Please note that this video does not contain any buy recommendations. Investing carries risks of losing money. Only invest in what you understand. We recommend choosing long-term investing, as it significantly increases your chances of success. What do you think? Leave your opinion in the comments.